Thank you everyone for taking the time to be here and participate. Hopefully you'll find today most advantageous. I'm going to get straight out to it because there's several slides that I'd like to get through today. But I just want to drive it home because I think today is probably some of the most important information, at least just in my experience, and that has benefited me over time. And so we'll get straight out. But first and foremost, of course, I want to just make note that this is for educational purposes only, guys and gals. Trading contains substantial risk and is, of course, not for every investor. An investor could potentially lose all or more than the initial investment. And risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. And only risk capital should be used for trading, and only those with sufficient funds should consider trading. Past performance is not necessarily indicative of future results, and so on. Okay, so all right, let's go ahead and get through that. And what I'm going to try to do is move as swift as I possibly can. I want to make sure that I have the chat and the questions and so on. But if you guys can't, excuse me, if you can, just bear with me a little bit so that I can get through. And then we'll actually get out to the live charts, and I'll be happy to answer any questions that you all have. All right, so first and foremost, what are we going to be talking about today? Supply and demand imbalances. All right, and keyword there being imbalance. And we're going to focus solely on two patterns. I would encourage you probably, we're going to go through the patterns in the beginning, right? But I would strongly encourage maybe not to focus on the pattern alone. Towards the end of the session, once we've covered the information, I think you'll circle back and you'll kind of understand what I mean. So it's a whole, it's a plethora of information, and it needs to be combined in order for it all to make sense. Okay, but first we got to cover them. So let's get out to our demand price patterns. And as I said, we're only going to talk about two, of course, on the supply and demand side, right? So if we look at our demand price patterns, in these patterns, price briefly consolidates after moving up. So if we take a little visual here, we can see price, of course, moving up. And as we state, it consolidates. And in that consolidation, as you can see here in the rectangles, price begins to accumulate, right? Specifically on the buy side. So demand being buy orders, supply being sell orders. But as I said, inside of that rectangle, it's very important here, buy orders begin to accumulate inside of the consolidation. Some of this will probably make sense, some of it may not, but as I said, when we get to the end of the session, I think a lot more will. Okay, so continuation, right? So first we said, okay, well, here's a pattern, if you will. These are just candles on a chart. Could be a minute, could be tick, volume, and so on. So that it briefly consolidates, and that's how we know we're starting to see the pattern, right? And as we stated, inside of that pattern, it's just starting to accumulate, all right? And then the continuation. So the continuation is, I would say probably the most important part, right? So the continuation occurs due to the consumption of the sell orders. So if we're moving up and then we pause, if you will, or go sideways and accumulate, the important distinction here is that follow through, right? The continuation is what tells us who got consumed. Was it the buyers or was it the sellers? And in this case, as we're notating demand patterns, we would indicate here that it was the sell orders that got consumed. And we know that for a fact because price indeed did move higher via that, the departure is what we would call that. Okay. Let's look at supply price patterns. As I said, I am going to move pretty quickly so we can get out to the charts. I always enjoy it when people can actually see it in action. So the supply price patterns, as I mentioned previously, the difference there being demand is on the buy side, supply is on the sell side. So price, excuse me, briefly consolidates. In this case, it's after moving lower. And inside here, sellers begin to accumulate inside of that consolidation. So that rectangle area, what you're seeing there, the reason that it's going sideways is in an accumulation of the sell side. And then finally, the continuation occurs due to the consumption, in this case, of buy orders. So if we circle back for a second, in demand, we're consuming the sellers to go higher. In supply, we're consuming the buyers to go lower. I'm literally staring at the charts as we speak, and it is unbelievable. In fact, we've had three, there were three setups just in our room this morning. So, there's a lot of them, and it's applicable across all time frames. But as I'm staring at the chart, I mean, they're literally happening as we speak. Um, and to me, it's unbelievable how we can sit there so that when we're looking at these patterns and we're thinking to ourselves, that how simple that looks, that's exactly what I would like for you all to be thinking. How simple that looks, right? It's almost, it kind of looks like maybe crayon. I took some crayons and drew some, kindergarten pictures or whatnot, but that's okay because that's how simple I want it to feel. Now that we know what the supply and demand levels are, we want to talk about qualifying them. There can be, as I always say, there can be an amazing, let's say, supply level, right? I mean, it can be picture perfect, but if it's in the wrong location, that level will most likely fail. Now you can go, conversely and look at a relatively okay supply level, but if it's in the right location, that level is most likely to prevail. So it's more about the location and if and when these things are occurring. So I don't want to get ahead of myself, but it's always hard not to. I get so excited with these things. I love spending time doing this. So we know the price patterns, right? Please remember, I'm not all over the board here. We're not talking about 20 different patterns. We're not talking about tons and tons of information. Very simple, very basic information. Okay, so two patterns: supply pattern, demand pattern, and we're literally just looking at one on each side. Okay. All right, so now that we want to move forward a little bit, we know what the patterns are, but we need to qualify them. We don't want a poor looking, let's call it non-qualified level. We want them to be extremely qualified. And more importantly, we want them to be in the right location. So if I have two things working in my favor, now I have an amazing looking level, but I also have it in the right location. That's superior. Okay. So the first question, we're going to say, did price depart from the consolidation fast or slow? Very simple question. And to be honest with you, a lot of this information, like I said, we've been doing this since about 2009. We used to have YouTube videos going back to 2009. It's just, outdated and things like that. This information, some of which very basic, it's been out there. This is not, we're not trying to reinvent the wheel or throw rocket science here or whatnot. So this is a pretty standard question, but it may be new to some folks. It depends if if you've done a lot of supply and demand analysis or support and resistance analysis, things like that. So if I'm talking to a fib trader, right, this might be, quite unique. Just depends on the trading style. So what in the world does that even mean? Did price depart fast or slow from the consolidation, right? So we want to take those same patterns. On the left side, you'll see that this is the supply, right? And we know that because price is moving down. Obviously an important distinction there. On the right side, we're looking at demand because price is moving up, okay? In these particular patterns. Please remember, there are others. I'm not in any way saying there aren't, but I don't need to focus on all the patterns. I just need to be consistent with the ones that I do focus on, okay? So how did it depart, right? This right here is a very, very important part. And we'll come back to this later in the presentation and really talk about the why behind this. But suffice to say, right now, we just want to know that is part of qualifying the level. How did it depart? Was it fast and abrupt or slow, and diagonal, if you will? Okay. So in each case here, you can see that it goes straight up and or straight down. Supply goes straight down and the demand goes straight up. So those are great. Okay. The speed and the distance are going to help determine the strength and or the weakness. So if it's moving fast and for all intents and purposes a grave distance, that's wonderful. It's super strong, right? Conversely, if it's slow, then you're going to have the opposite. It's going to be weak. So again, we're qualifying. In other words, to simplify this, we want to see it break out of that consolidation and move in the corresponding direction very fast. So the faster it goes, the happier we are because we're substantially qualifying our level. So we have another question we want to ask ourselves. How many bars closed while inside of the consolidation? Now, this is important before departing, right? Before departing. So if we look at those same two patterns on the left, the only thing that's missing here is the consolidation. On the right, you're going to have demand, left, supply, and this will make sense on my next click here. But I need to know how many bars are inside of that consolidation, okay? The number of bars is going to indicate, I'm sorry, I'm a little bit distracted here as I just had a break-even trigger. I'm hoping that I can get through this. I was hoping to let you all see that as it was happening, but price is moving a little bit too fast. That's okay. Monday, plenty of time. So the number of bars indicate how decisive the buyers and or the sellers were at the time of formation. Okay. So in this case, fewer bars, you might think this would be the opposite, right? I don't know. But so less time or fewer bars equates to very decisive. They had no trouble making the decision that they made. On the left, the decision that they made was obviously stronger on the sell side because we have a supply level and price ended up moving down. On the right side, of course, we have a demand level. So the decision was prominent on the buy side. Okay. So again, just let's back up for a moment, qualifying the levels. We want to understand. Let's back up to the previous. Let's see if I can just back up. I just want to. These are only two questions, right? So did price depart fast or slow? And then how many bars closed within the consolidation? And that's basically it, right? I mean, we're simplifying this down to just a very, very basic level. And at the end of the day, we can complicate it substantially, but there's no necessity for that. And we actually don't use any. What we're doing right now is exactly what we do. So we try to keep it that simple because price action, in our opinion, is the one thing that really can't be manipulated, right? Because what you see, it's really already occurred. Okay. All right. So we'll keep moving forward there. Now, we talked about the bars within that, right? So how in the world do I even determine that? What does that even mean? So if I say that there's, 6 bars inside of my consolidation and so on, I need to understand exactly how to go about, counting that, if you will. Let me see here. Sorry, guys. I see. Oh, sorry. I was trying. I couldn't. The Q&A there was a little blocked for me. I see your question though, and I apologize if I miss any more, but I definitely will come back to those towards the end of the session. But you just joined. Welcome, by the way. You're just asking what time frame are you teaching on? I'm going to show you that in just a moment. I'll actually show you exactly what we, what we do in our live room. So the charts and stuff that you'll see is exactly what we do every day in our live room. But to give you the answer as I move forward, right now I'm staring at a daily chart, a 4-hour chart, and a 3-minute chart. Okay. And just to let you guys know, because I think I don't know if this is going to happen, but you can just watch the S&P. Right now I have a target at 41.55 quarter. It's dropping so short from 41.64 quarter with a target at 41.55 quarter. And the trigger line just got met. So I may not be able to show you all this, but you can keep an eye if you have a chart open maybe. Again, that's 41.55 quarter. And we will, if we don't get a chance today, which I believe we will, we'll absolutely do that on Monday. Okay. All right. So how do I count those bars in the consolidation, specifically in the demand? So I'm going to have to break these apart because they are different, of course. They're going in 2 different directions. So if we look at, we want to determine the highest high, we're going to look at the pattern, and we're going to determine the highest high after price moves up. So I'm not, this could be any bar. We're not saying that, it has to be some specific bar or anything like that. It's literally as price is moving up, just count the high, right? Or determine it, excuse me. So of any bar, doesn't matter where you are, in order to locate and define these patterns, however, we do need a move up, of course, and then we need to grab that high. So the next thing I'm going to do is adjust to each new consecutive bar's high that forms. Again, this could be any bar, right? So it could form in the middle of nowhere or where we think it should or whatnot, but ultimately I want to define the high and then adjust to every new bar's high, right? So every time we make a consecutive high, I'm going to get rid of the previous because that's of no relevance anymore. I'm going to move on to the next. So this becomes my new high, right? Same thing here. I have a new bar, but this is a red bar, you say. Well, it's a little bit different. Of course, yeah, being the color, meaning that it closed lower than it opened, but it doesn't matter because the candle in itself made a higher high. So what I would do is get rid of the previous and thereby count the new high, the new bar's high. Okay. And now what I want to do is just continue that process. I'm just going to keep going. So as long as it continuously makes higher highs, I'm going to move that particular point, if you will, which you'll know in just a second. I'm just going to keep moving with that. And once I finally, revisit a bar that fails to take out the previous bar, okay, so I'm going to say it as I have it written. I'm going to count the high bar plus each bar which fails to surpass the high bar's high. Simply put, so long as we don't violate that previous bar's high, I'm going to count that bar, okay? So here I have one, let's go back. So the high bar becomes bar number one, right? And we don't know that yet. So there's no way for us to know that, okay, well that, the next bar is not going to take that bar high out. So, but pretty much suffice to say, the high bar, we are consistently moving and adjusting to whatever that is, knowing that that is going to become bar number one. So then we move forward. As long as the high of said candle fails to take out the previous candle, that becomes bar number two. Same with bar number three. And then finally we have a bar, but as you can see, this particular bar, it actually takes out the bar number one's high, right? So if I go back and look at that closely, we can see there it violates the previous bar number one's high, okay? So this bar does not get counted. I could say here that I have 3 bars inside of my consolidation. Give you another example here. We have a bar's high, and basically I'm just using the same demand patterns as the previous slides. So we have a bar high. We have another bar high, so I'm going to get rid of the previous and move and or adjust to the new consecutive bar's high. Same thing occurs again, so I'm going to continue adjusting. Finally, I have a bar that fails to surpass the previous bar's high, thereby that becomes bar number 2. So we have now the high bar, which is bar number 1. We have number 2, which fails to surpass bar number 1's high. And we just keep going with that same process. So in this case, we now have 4, but we've never violated the bar number 1 high, which I refer to as the high bar. So as long as that high bar is intact, we keep counting. So here we have 6. And here I'm going to stop now because that candle has violated bar 1 or the high bar. Okay. So yes, it does not get counted. A very important distinction, none of this is done intrabar. So as I'm doing my counting, I can't count the bars intrabar because I don't know if it's going to violate the high bar or not, right? So I have to wait for them to fully close, and then I can go ahead and count or not count. All right, so how do I count the supply bars? As you could imagine, I can move a little bit more swift through this one simply because it's relatively the same, just inverse to one another. So we determine the lowest low after price moves down. Here you can see we have a down bar. Okay. So we're going to determine that low, and then we're going to just keep adjusting to each new consecutive bar, shall I say, each new low. Okay. So there we have a new bar low. I'm going to adjust. If I could click on the right thing there, it would probably help. So I've adjusted to the new bar's low. Then we have another bar that forms a low or a lower low. So I'm going to adjust again. Now I have a new bar's low. Okay. I'm going to then begin counting the low bar. So that's going to become bar number 1 plus each new bar that fails to surpass the low bar's low. So as I said, it's just inverse to the demand patterns here. We have the low in the demand. Of course, we have the highs that we were focused on. In supply, we have the lows. So the bar low, that becomes bar number 1. Number 2 failed to surpass. Number 3 failed to surpass. The next bar, however, did not fail to surpass. In fact, it departed quite nicely. So I do not count that bar. Inside of this consolidation, the answer to my question, how many bars are inside of my consolidation, is a very simple answer. I have 3. Okay. So this would be considered a 3-bar consolidation. Over here, I'll give you one more example. We have a down bar, so we know we're moving lower, right? So that's the key thing there. We're moving lower. We must be moving lower in these particular patterns for supply, and we must be moving higher for demand in these patterns that we're referring to today. Okay. All right, so the down move, we have a new low. We're going to adjust accordingly, and we're going to continue that process until we have a failure to take out that low bar in this case, until we have a failure to take out the low bar. So now we have 2 bars, 3, and just continuing that process until we violate the low bar's low. All right, so that bar, of course, does not get counted. All right, if I said on the right, I'm going to ask myself a question, or 2 questions really. Number 1, how did price depart, right? That was the first qualifying question. How did price depart? Well, it went vertically down, so that's good. Of course, we would need to see follow through. This is just one candle breaking out of it, but using this for illustration purposes. So it broke straight down. Okay, great. Now, how many bars are inside of my consolidation? So if I look at that right pattern, I can see there's 6. If I look at the left pattern, I can see that there's 3. We'll discuss this further in the presentation. So it's ironic, but sellers cause demand levels. Please revert back to the beginning of the presentation when I said, let's put this all together, right? So we know the demand levels. There's only, 1 on each side. So it equates to 2. We understand how to qualify them with literally 2 very basic questions, okay? And then we're going to move on to understand more of the functionality of them. So again, I want to just reiterate sellers. So this is the opposite, right? So sellers cause demand levels. That's weird, right? That sounds weird because demand is buy orders, right? Yeah, doesn't even sound right, but it will in a moment. Price stops moving higher when sell orders are reached and cannot continue higher until 100% of the sell orders are consumed, okay? All right, so let's get through this and then I'll answer any questions in regard to it. But let me just repeat that. Price stops moving higher, right? So here, obviously price is moving up, okay, on both of these patterns. When price stops moving up, we know for a fact that sell orders were reached because there's really no other reason to stop, right? So what is it that stops price from moving higher? It's always the same, sell orders, all right? We'll talk about the inverse of this in just a moment. So price is going to stop moving higher. We know there, okay, oh, great. Well, sell orders have been reached. And more importantly, it cannot continue higher. There's no way, it's not possible for price to go up until all of the sell orders are consumed. Okay, it just can't. I mean, literally, not even one. So we have to get rid of all sell orders, and then price, of course, will go higher. Okay. All right. So basically, I was just indicating to you there, this is where price stops, right? So we know that there are sell orders there. The high bar indicates where they are. In other words, the sellers. So we know that we've reached them when price stops, and the high bar, okay, of the demand levels, that's what is going to indicate that for me. And the consolidation followed by continuation confirms there were not enough sellers to reverse price's direction and new demand accumulated. Okay. So sometimes I have to repeat things even for myself, right? I know this like the back of my hand, but it's always good for me to read it for you and then to read it out loud for myself so that I can be a little bit more explanatory. The consolidation followed by the continuation, right? So if it's not enough just to have the consolidation is what I'm trying to say here. Yes, we have a consolidation, but that's only telling me that there's an accumulation of buy and sell orders. I don't know the rest of the story, right? I need more information. Thus followed, oh, sorry guys, that was I'll explain that moment, the break even there. So the consolidation, but then followed by the continuation, right? So that's this part right here. And that's what confirms that there were indeed not enough sellers to reverse price's direction, and thereby new demand has accumulated. We know that because we hit sellers. So in order to get through them, the buyers have to regain their composure, accumulate once more, and then your departure takes place. Okay. All right. Conversely, as I said before, we look at the inverse. Buyers cause supply levels. So again, that sounds really weird because we know supply is actually sellers, right? Sell orders. So buyers cause those supply levels to actually form. It's like footprint, right? Not footprint chart, but it leaves footprints on the charts for us. Footprints meaning levels that we can go back and historically view. So price stops moving lower when buy orders are reached and cannot continue lower until 100% of the buy orders are consumed. So here we're moving lower, we stop. Okay, so that indicates where the buyers were reached. And then the consolidation occurs, followed by that same continuation, right? Very important. So that we consolidate, then continue, which confirms that there were not enough buyers in this case to reverse price's direction, thereby new supply accumulated. So there's that continuation or departure. All right, so now we want to locate demand at resistance. I realize I'm moving very quickly, but we've already been here for 30 minutes and I only have 45. So I apologize if I'm moving too fast. Monday, we'll have all the time in the world. So let's locate demand, right? We're going to do that at specific locations. Very important. We're putting it all together now. We're saying here's the supply and demand levels. This is how we qualify them, basic 2 questions. And then we're going to start focusing on the location, right? So we want to look for demand to accumulate at or near previous resistance levels. So here we have a resistance level. Supply is weakened after retesting the resistance level many times, right? So when we retest that level, it is definitively removing orders from that location. Not to say they can't be added back. People replace orders, and so on. But we're talking about like institutional order flow, which was initially submitted. All right, so we have that resistance level there. Could be any resistance level. We'll look at that a little bit more in depth. But the supply at said resistance level is weakened after retesting it. So the more times we retest it, the weaker it becomes. Okay, and that's basically what we're saying. So as supply weakens, the buyers may more easily accumulate and consume the remaining sellers. Okay, so we're saying as the supply and or sellers, they weaken because we continuously are retesting that area, then it's easier for the buyers to violate them, right? Okay, so here we can see price consolidating. I would ask myself, I need to see the departure. I need to see how many bars are within that consolidation, qualifying it, and so on. Okay, so when I come to the resistance level, that's exactly what I'm doing. I'm saying, all right, it's retesting it. Now let me start counting bars, and then I'm going to look for this right here. Okay, because now I know something that I didn't know before. It's a proven fact that the buyers have indeed consumed the sellers. So if buyers are consuming sellers, and we know that sellers are there because it's resistance, right? So if we can get through them, we know that the buyers, they just accumulated. So that becomes a new level. We can focus on that. But remember the previous slide where I was saying supply, you could call it and or resistance if you like, creates demand, right? It's not so much that it creates it, rather it's the location in which the demand is going to occur. So here that resistance level is sellers, right? There are sellers almost always at resistance levels and so on. And in order to get through them, I have to accumulate the buy side. So this is what's leading me to, okay, now I get it. Yep. So this is not just any level. This is a level that has proven something to me. Okay. So we want to locate supply at support. I back up one slide. Demand is at resistance. Supply is at support. Okay. So we want to look for supply to accumulate at or near previous support levels. Demand in this case is weakened after retesting the support levels many times. Same concept as we previously stated, of course, just on the other side of the market, right? So here we have a retest of the support level. So the more times that occurs, the weaker the demand becomes, thereby the sellers can now more easily accumulate and consume the few remaining, the few remaining buyers. Okay, so we consolidate. I'm qualifying that level as it is occurring, and that's what I want to see. And how do I want to see that? Slow or fast? Fast, very fast, because remember the question, and fast was very decisive, slow, indecisive, right? So I want few bars, fast departure. All right, next, and we're getting towards the end here, I want to locate demand at resistance, right? Same thing we were looking at before, but we already said that. Well, we did, but there's multiple types of resistance. So previously on the slide, we stated that we wanted to look for demand to accumulate at previous resistance levels, okay? But resistance, as I said, it comes in many fashions. In this case, we're going to talk about a resistance line, okay? So it's when we can put a line on multiple structure highs that are relatively in the same line, okay? Supply is weakened after retesting the resistance line many times. So the same concept, you can see we have a resistance level, you get, continuously retesting that, it weakens. When you have here, similarly, a resistance line, you continuously retest it, it weakens, right? Yeah. Okay, excellent. So this is where I'm looking for the demand, okay? Now, that's good. I'm not trying, it's like looking for sheep, right, or something, or like if you're stalking your prey as an animal or whatnot, the lion, they look for the weak of the herd, right? So they're going to go after the weak. So that's what we want to do here. I know that sounds bad, a poor analogy on my part, I'm sure, but I have to use it, right? Because what we're doing is we're doing exactly that. We're looking for the supply to be weakened. We want it to be weakened because then it becomes much easier for the buyers to prevail. Okay? So as I'm saying there, as supply weakens, buyers may more easily accumulate and consume the remaining sellers. So this is where we consolidate. It's where we start to accumulate. The departure tells me, it confirms it, right? Now I know. So I've been proven, or rather it has been proven that demand exceeds supply. And remember in the very beginning of the presentation, I stated the term imbalance was very important. This is why. Because not only do I need to see the level, I need to see it form and execute in a way that tells me something. I don't need random levels. I need very specific levels. Okay? I need a lot of proof, right? So I want to locate supply at support. Demand was at resistance. Supply is at support. So I want to look for supply to accumulate at or near previous support lines. We can see there we have a support line. Demand is weakened after retesting said support line many times. And then I begin looking for my supply level. Okay, so as demand weakens, sellers may more easily accumulate and consume the remaining buyers. So here we have the potential, right? Now I'm starting to count my bars. We consolidate and or accumulate on the sell side. And finally, I know for a fact that it has indeed been the sellers to exceed the buyers. Okay. All right, so see, it was not too bad. It's a lot of basic information. I think I'm doing okay on time. We'll probably go ahead and get right out to the charts. Yeah, not too shabby then. Excellent. All right, so give me just 1 second here. I'm going to just introduce you guys and gals to our zone sweep. So everything that we talked about today, right? We talk about like automated levels and things like that. So that's what the PFA zone suite does. This is our custom software, again, in development for over a decade. Been doing this a long time, loads of bells and whistles. I used to say, I could do all this manually and things like that, but I have just become so accustomed almost dependent even on the software just because it makes my job way easier. We're talking about it in the session this morning, how we went and changed up orders and moved things around so very fast, so it was really efficient. I was able to do it in just a few seconds. It's very nice. So this is a tool, an indicator, if you will. So it's NinjaTrader 8 compatible. It's designed to reduce subjectivity and increase time efficiency by automatically drawing supply and demand zones on any price chart. It utilizes price recognition, volume distribution, market volatility, and many, many other in its calculation, which are displayed on the chart with custom graphics. They can be used for enhanced confluence purposes, it could be used for whatever. I mean, there's really no trading style, in our opinion, that this couldn't benefit. Let's say I'm a fib trader, but I don't even pay attention to supply and demand. Well, I think we all should. Of course, where the supply and demand is in the market is obviously very important. So if I'm about to hit, based on my Fibonacci pattern, if I'm about to hit, an ABC long, I know that terminology, I shouldn't say. So let's say I'm about to hit a pullback and I'm looking to go long or buy again. Okay. Well, having this on my chart, I may see that there's a huge red zone right there in front of me. And that indicates, hey, you're buying right into supply. Right, so it just helps always kind of trying to keep us on the right side of things, right, and our thought process intact. Did I do it? Am I good? Thank you so much, and I appreciate that. And are you guys seeing my charts? Can I just get a quick yes or why or whatever? Anything works, really? All right, I'm looking in the chat. Just want to make sure that I'm not. Let's see. Okay. Can you guys help me out? Okay, I do see. I'm sorry. So see, this is, I can't really see the questions, guys. This is going to be a little bit problematic. I can't see the questions and you guys and gals typing, which is most unfortunate. But Monday, I'm telling you, we'll absolutely get to all of the questions. I don't know what's wrong with the GoToWebinar thing here, but it's blocking all of your questions. So let me do this real quick, okay? There you go. Shoot an email over. As promised, I get you the contact information. Shoot an email over. Any questions, I'll be happy. I'll even have a one-on-one personal conversation with you if you like. And you can just shoot me an email and we'll set up a time. I'll call or we can email back and forth, however you like. Okay. Real quick, in conclusion, and as I said, on Monday, we'll be talking about all of this, but in the final minute, I'm getting down to it. These were the 3 setups. So as you can see here, our software is printing it, right? You see that line there. These are very specific patterns. And based on location and the information that we've discussed today and further information, which we can discuss on Monday, these are the 3 setups that have occurred today. So we had 2 shorts this morning, followed by a long, right? So very short-term trades here based on larger time frame and smaller time frame. And you can see all the previous stuff setting up right now. So this is where my trade previously was, right in through here. So that was a short setup there. And then the target was just down here. But so it hit the trigger line right here into this demand, pulled back to our supply level. That's where my break even, that's what you heard go off moments ago. And then, it took me out at break even plus commissions, but still looking for that lower target. Okay. God bless you all. I sincerely appreciate your time. I really hope that it was of benefit today, but on Monday, I will dive so deep and do my best to help you all with any questions, answers, anything like that. I want to thank you again for your time, your participation, and your willingness to listen to me go on and do my best to help. Okay. Thank you. Bye for now.